Go. Good morning. Good morning. There we go. Let me make sure the technology is working. And of course, if you're watching this recording, feel free to skip ahead about a minute or two to get to the content. Thank you very much. And when you hop on, let me know who you are and where you're from. And while you're getting on, I'm going to share this out in a few places and keep it moving. Good morning. Ooh. Right. Let me share this out. All right, almost there. And we get one more place. Almost there. Oh my gosh, that's hilarious. Okay. All right. Okay, there we go. Seems like my phone is going to sleep. But okay, so there we go. It has been shared out. Good morning and welcome to the show. My name is Lysandra Everett. I am the Home Biz Tax Lady. I help home business owners win the tax game by helping you keep more of the money you make in your pocket and paying less to Uncle Sam. Okay, so today I want to talk about IRS penalties. All right, so here we go. Everybody was, doing the happy dance when the current administration announced that they were cutting funding to the Internal Revenue Service, right? Everybody's like, woohoo! The IRS doesn't have as much money, so they're not going to be able to do as much work. Well, that's not true. And why? Because of automation, okay? So let me give you some statistics. In 2005, accuracy-related penalties assessed were 58,366. So just a little over 58,000, right? In 2014, there were 554,467 accuracy-related penalties assessed. And this information comes from the IRS data book. So, so over 9 years, the accuracy-related penalties have increased 950%. And, you ask yourself, okay, well, is it that, there's more unscrupulous taxpayers, or is it something else? Well, I'm going with a little of both, but a little more on the something else side, meaning that automation is allowing the IRS to do its job better, okay? Where normally it would require human intervention to find, to assess these penalties, to find these inaccuracies. Now we got computers to do it. So one of those things is called the Automated Underreporter Program, okay? And so what this does, this is all done by computer matching, okay? And so we've talked about before how with the IRS, when you get a tax document in the mail, you need to know that the IRS also has a copy, right? So if you get a 1099, a W-2, or whatever in the mail, something from your investments, all of these forms have already been sent to the IRS. So the IRS already has these documents. They're just waiting for you to confirm what's already been sent, okay? So where this used to require human intervention, now there is a program that does this, and it's happening a lot faster now. So, so what I'm telling you is that, when you get these tax documents, please do not ignore them, because the IRS already knows, they're just waiting on you. So what happens is the IRS matches the information from the third party, okay? So let's just say I get a 1099 from my affiliate marketing company, okay? You should get a 1099 if you made $600 or more. but you still have to report all of your income. That is your responsibility to report all of your income, but you should receive a 1099 if you get paid $600 or more. Okay, so let's say I get a 1099 from my affiliate marketing company with, for $1,000. Okay, I made $1,000 this year with my affiliate marketing company. Now, that company is also sending that to the IRS, and so once I file my taxes, okay. Once I file my taxes, then that's when the computer work starts. The automated underreporter program, they start running it from the time that the tax is due, okay? So if your taxes are due on April 15th, then that's when they start running these things. Usually you start getting letters, the May, June timeframe, because April 15th is when all the, is usually when the taxes are due, unless you have filed an extension. But taxes due April 15th. Okay, so after April 15th, that's when they start running the computers, and the computer goes, ding, Lysandra has filed her taxes, but she didn't report this 1099, and we got this 1099 right here. Bing, something's wrong, okay? So then, so there's that, there's that discrepancy that basically raises a red flag. And so now what happens is that's when you start getting letters. Now, what tax examiners do, and this is what I got from a tax examiner, okay, at the IRS, what they do is they really want to get it off their desks, right? They really want to try to get it resolved. So that's when you start getting letters that show, hey, this is what you filed. This is what we have. This is the adjustment that we've made. You owe us, $300 and, send us our money. Or if you disagree with what we have, then you need to show us why you disagree. So the main thing here is when you get a letter from the IRS, do not ignore it, okay? That's not going to make things go away. Do not ignore letters from the IRS. And again, I reiterate letters. The IRS does not call you. They do not email you. They use regular old postal service, put a stamp on it or whatever they do, and send it to you in the mail. Okay. So, but that's when you get a letter in the mail that shows what you filed versus what they have. And they'll tell you that, there's a discrepancy. Okay. And so then you have to either say, yeah, I agree with it and write the check, or, no, this is not accurate. And then that's when you need to work with the IRS and say, hey, this is not right. And here's why this is not right. Okay. So, and that letter that shows the changes is called a CP 2000. Okay. There's some way cool information that you probably won't need, but that's what it's called. Okay. And then after they send that letter and then you haven't responded, then they're going to send you a letter of deficiency. Okay. When they send that first letter that says, hey, what we have doesn't match and this is what you owe us, you have 10 days to respond. And on that letter, they'll generally put, you have until this date to respond. Okay. So don't ignore that date, because when you ignore that date, they're coming for you. Okay. So don't ignore the date. The dates are important. All right. So they will send you this letter. You've got 10 days. And then if you don't, then they're going to send you what's called a 90-day letter. That shows your deficiency. Okay. That's when they start the collections process, the statutory notice of deficiency that you'll get. And that's what it'll say. That is the start of the IRS collections process. All right. So that's why you want to respond on that first letter and don't wait for the 90-day letter. Okay. Because that's not cute. Okay. So then what happens is this is kind of the process. So this letter that you get is computer generated. Okay. There's not a person that is involved in this yet. Then, they keep these in a suspense file. So they keep a rolling file of these letters. This is why I say you can't ignore the IRS, because they're keeping a rolling tab on all of these letters. And they have, a preset, suspense date. So if by day 10, or whatever that date is, they have not heard from you, no calls, no check, no nothing, then okay, ding number 2, go on to the next step. And then, if no response is received, that's when they're going for the collections process, and you don't want to do that. Now, here's the thing, and this is what I tell people all the time. If you have a debt to the IRS that you can't pay, ignoring them is not going to make it go away. You really need to call them and work with them, or call someone like me, or a CPA or a tax attorney that can help you deal with the IRS. All right. You don't just ignore them. Now, if you dispute the liability, if you say, okay, hey, this isn't right, then you definitely need to make a phone call, because they'll tell you what you can do, whether it's a phone call, if you need to fax something or whatever. You just have to read the letter. It'll tell you exactly what you need to do next. And then, that's when it goes to a person and they review your response, and then they make adjustments and they make a determination on the case to say, okay, we see how this is an error. Okay, so, that's done. Or no, you owe us this money. Okay. So again, you want to make sure you respond before the deadline of the first letter. When you respond, you want to include everything that's in the letter, including a copy of the letter, because in the letter, it will tell you to put your case ID on there. So you've got to follow the directions that are on the letter. Like, so much stuff gets lost at the IRS because people don't follow directions. Okay, you got to follow directions. They often supply a return envelope. Use a return envelope. You would think this is simple stuff, right? But sometimes what you need to send back isn't going to fit in their envelope. So what you need to do at that point is get an envelope big enough to send your stuff, but you need to tape the return envelope that they give you to the front of that big envelope, just so they can have that computer tracking. And you want to provide as much detailed information that, as to why you're disputing whatever the liability is. You want to say, hey, here's this, and this is why I don't believe this is correct, blah, blah, blah. All right. So, that's really it, guys. The thing about it is, nobody likes to pay taxes. Who in their right mind likes to pay taxes? Nobody. But it is a necessary evil. Now, are there, segments of the population that believe income tax is illegal and all of that? Yeah. But there are plenty of ways for you to legally avoid paying taxes, which is not the same as tax evasion. Tax evasion is you owe and don't pay. That is illegal. Tax avoidance is legally taking advantage of tax laws so that you can reduce your tax liability. So there are so many ways to legally avoid paying taxes that, you don't have to go through all that stuff. Okay. All right. So I have a question here. Let's see. It says, how can I go about filing the last 3 years? Okay. Okay. All right. Got it. So, Miss Lewis, I will send you an inbox with the answer to this question. Okay. And thank you so much for tuning in. All right. So, but that's it for the live broadcast, guys. Accuracy related penalties. You got to make sure that when you get these forms in the mail, guys, you got to report it. Okay. You got to report it because the IRS already knows. Foreign bank accounts, like, people try to put their money in foreign bank accounts to try and duck the IRS. Well, there is this foreign, I forgot the acronym for it, but the nuts and bolts of it is there's 113 countries in agreement with the United States that they report over a certain amount back to the IRS that you have in their bank accounts. Okay. So again, the IRS is just waiting on you. And if you don't report it, they will come for you. That is all. Okay. Good morning, Arabella. All right. So listen, that's it for me, you guys. Have a fantastic day, and I will see you next week. Oh, listen, you got to get over in the Tax Players Club. We got some great stuff going on over there. That's my Facebook group where I share exclusive training over there. And that's, let me put it here because y'all know. Okay. You know what? I just need to wait until this is over. I don't know why I do this to myself all the time. I'll add the link once the broadcast is over because it never works out and just forget it. All right. So I will see you guys next time. All right. Bye.